So if you were watching the market screens right at the turn of the year, the last few months of 2025 were pretty brutal for Nike, ticker NKE.
Oh, absolutely.
The stock had seen massive volatility, major drops, and frankly, a lot of analysts had already, run for the hills. They were convinced the brand was just stuck.
It was a really challenging close to the year. I mean, that recent earnings report for Q2 fiscal 2026, it just created so much downward pressure.
Yeah.
The general sentiment was overwhelmingly negative. It felt like the market had priced in all the bad news and then started looking for more.
That sets the perfect scene for what we're talking about today. Because right when the sentiment was at its absolute lowest.
So, I mean, rock bottom.
Exactly. Something happened that usually signals a massive shift. We got this flood of SEC paperwork, the famous Form 4 filings, showing really aggressive clustered insider buying. So our mission today is to dig into this, analyze the data point by point, and figure out if this is truly the bottom signal that contrarian investors look for, or if this is, just a coincidence.
And we don't have to look very far for the catalyst. The big piece of news came late on December 30th. It was that the person running the entire company, Nike CEO Elliott Hill, had just invested over $1 million of his own money into the stock.
Okay, let's unpack this.
Yeah.
What exactly does it mean when the person responsible for the company's performance make $1 million personal bet right after a huge price crash?
It just screams conviction. It's the executive equivalent of, well, it's like he's slamming his fist on the table and declaring, the market is wrong and I'm willing to bet my own net worth on it.
Let's get into the specifics then. Pulled straight from that Form 4 filing. Now, for anyone who doesn't follow this stuff, a Form 4 is a legal document. The SEC requires it whenever corporate insiders, officers, directors trade their own company's stock, and this filing confirmed it. Purchaser, Nike CEO Elliott Hill. The transaction date was December 29th, 2025, right at the lowest point of market sentiment.
And the details are precise. He bought 16,388 shares. The average price, $61.10.
So you crunch those numbers. That means he deployed roughly $1,001,306 in a single day.
A very powerful move.
And the market noticed instantly. We saw a 1.54% spike in after-hours trading. That confirms the street reacted immediately.
It's the strongest signal you can possibly get. We often see insider selling, and executives sell for all kinds of reasons. Portfolio diversification, taxes, buying a house.
Right. Selling is ambiguous.
Exactly. But when a CEO digs into his personal savings to put 7 figures into the company's stock, there's really only one interpretation. He believes the stock is profoundly undervalued at this level. He's putting his own capital behind the internal forecast.
But this story isn't just about Elliott Hill. I mean, if it were just one single buy, we might see it as just an opportunistic gesture. But this buy was the exclamation point on something much, much larger.
That's the crucial pivot point. This action by the CEO completed what we call an insider cluster. This wasn't an isolated event. It was the final purchase in a massive wave of high-level insider buying over a really short, kind of frantic 10-day period.
10 days.
From December 20th through the 30th.
So who else was stepping in to buy the dip with the CEO, who had that same level of conviction?
The names are huge. First, you have Tim Cook.
The Tim Cook, Apple CEO Tim Cook.
The very same. He's also Nike's lead director. And his position is interesting because he has strategic oversight, a very broad perspective on the company's future. And just 1 week before the CEO's move, on December 22nd, Tim Cook bought about 50,000 shares.
50,000 shares. That's a lot. That's a lot of money.
It works out to roughly $3 million.
Wait, Tim Cook dropped $3 million as a director, and the CEO just dropped another $1 million? That's $4 million from two of the most influential people in tech and apparel.
And the cluster keeps going. Director Robert Swan, who brings decades of financial experience to the board, he also purchased about $500,000 worth of stock in that same 10-day window.
So if we total this up, over those 10 critical days, we're looking at nearly $4.5 million poured into the stock. And crucially, it's all concentrated right around that deeply depressed $58 to $61 price level.
That clustering of conviction. That is the key takeaway for you. It validates that famous principle of insider analysis.
Which is?
Insiders might sell for many reasons, but they only buy for one.
They believe the price is going up.
Exactly. This isn't passive. This is aggressive action, deployed at the exact moment the stock found a technical floor. It's an undeniable signal.
Okay, so we know who's buying. We know they all bought at the floor.
Okay.
But we have to connect this confidence to, reality. The market was punishing Nike for a reason, specifically that dismal Q2 earnings report. Why are these insiders so bullish when the recent headlines have been so negative?
Right. What are they seeing that the market isn't?
Yeah.
They're buying because of the headlines, in a way. They're focused on internal trends and forward-looking data that the public market either missed or, frankly, sensationalized. The big worry was China.
And it was a massive worry, rightly so. China revenue dropped 17% in that last quarter. Q2 is fiscal 26. That kind of drop in a critical growth market.
Yeah.
That's why the stock plummeted.
That 17% drop was the headline everyone saw, and the pain is real. But the crucial counter-narrative, the detail these insiders are betting $4.5 million on, is the strength in their most important region, North America.
Yeah.
North American sales actually rose 9% in that same quarter.
Now, that's a real tension point. A 9% rise in North America, Nike's home base, that validates the brand strength.
Right.
But are you saying that 9% is really enough to offset the pain from a 17% drop in China?
The insiders believe it is, and here's why. The nature of that North American growth is strategically better. That 9% wasn't just driven by, deep discounts. It was driven by the success of their direct-to-consumer channel.
DTC, so higher margins.
Higher margins, greater control over pricing, less reliance on struggling wholesale partners. They see a healthy, high-margin, durable recovery in the West, and they believe that will stabilize the whole picture until China recovers.
That shifts the whole argument, doesn't it?
Yeah.
It goes from, is the brand losing relevance
Yeah.
to, is the brand executing strategically? Winning in DTC is a completely different story.
And this ties directly into the concept of the kitchen sink quarter, which we saw in Q2.
Right.
When management presented those results, they didn't just report bad numbers. They aggressively lowered the full-year guidance for 2026. This wasn't panic, it's a strategic move.
Explain that strategy. Why would a CEO deliberately guide the market lower than maybe even necessary?
It's the classic corporate reset. Management sees the climate as bad, so they take the opportunity to throw the kitchen sink at one quarter, get all the bad news, all the inventory write-downs, all the pain out in a single release.
And by lowering future expectations so much?
They set the bar incredibly low, so low that it's now almost guaranteed the company can easily beat those expectations later in 2026.
So in essence, the Q2 earnings report was management officially signaling the bottom. They're setting themselves up for a series of small positive surprises throughout the year, which is exactly what turns stock sentiment around.
It's a way to regain credibility, and if you look at the valuation, it supports this case. NKE is trading at a PE of about 28 times forward earnings.
Which isn't exactly a value play.
No, it's not dirt cheap. But what insiders are betting on isn't the current earnings. It's a rapid acceleration of future earnings that they see coming in 2026 and 2027. If they pull this off, that PE of 28 will suddenly look incredibly cheap in hindsight.
And this is where it gets really interesting. We've talked about the internal belief, but let's look at what the price action, what the charts have been telling the insiders.
The technical setup confirms the insider conviction perfectly. Throughout December, the stock was beaten down, and it firmly defended the $58 to $60 zone multiple times.
So every time it dipped below 60.
Buying pressure materialized, pushed it right back up. That price point is a clear psychological and technical floor.
We can basically trace the dynamic. Retail investors, they saw those scary 17% China headlines. They panicked after the earnings drop, and they just sold indiscriminately.
And that's exactly when the smart money arrived. The insiders Hill, Cook, Swan, they stepped in specifically to absorb that selling pressure. They literally caught the shares from the retail sellers who were running for the exits at the absolute low point. It's a textbook reversal.
So if this $4.5 million in buying momentum holds, and the market starts to recognize this reset, what's the technical roadmap look like? What are the targets we should be watching?
Well, the first most immediate target is the gap fill. A gap is created when a stock opens way lower than its previous close, which is what happened during the earnings sell-off.
Okay.
Filling that gap, recovering those lost prices, that sits right in the $68 to $70 range. That will be the first major test of this new strength.
And if it clears that initial hurdle, what's the next major level?
If the stock clears $70 with conviction, the next big resistance is the 200-day moving average.
Big one.
Right. It's the key line separating a long-term uptrend from a downtrend, and it's currently sitting at about $76. Hitting that would confirm the longer-term trend has potentially reversed.
So summing up our deep dive into the filings, the fundamentals, the charts, what's the final verdict on this massive insider bet?
Based on the sheer volume, the concentration, and the seniority of the buyers, this is viewed as a strong buy, a classic contrarian play. You're betting against the extreme negative sentiment, but you have the company's absolute top management backing you up with millions of their own dollars.
But we have to acknowledge the risk here. Volatility is still a very real risk, especially if those China numbers don't show any improvement in the Q3 report.
Absolutely. The macro environment, consumer spending, those are potential headwinds that even a $1 million CEO bet can't control.
The risk is real.
The risk is real, but the signal is rare. What's fascinating here is that the CEO put $1 million on the line at 61.10. Tim Cook put $3 million right next to him. If the people with access to all the non-public data like it here, we should probably be paying very close attention. The great Nike turnaround of 2026 may have just been quietly kicked off by these filings.
And that brings us to our final thought for you. Think about the tension in this trade. Given the $4.5 million insider investment, who is taking the greater risk? The external analysts and retail investors who focused only on that terrifying 17% China drop headline.
Or the insiders who just bet millions on the strategic importance of that 9% North American recovery. That choice forces you to consider which perspective is more reliable when the chips are really down: pure conviction and internal knowledge, or external headline data.